And President of the African Development Bank, Kiwumi Adesina, has also weighed in on the rising wave of trade disputes. Rwanda and South Africa have both been directly affected by punitive measures from the U.S. Now, he's now warning that African countries hosting firms exporting into the U.S. or China could be affected if the dispute escalates.
Take, for example, the agreements that we have, which is the AGOA, right? You have AGOA, which is for Africa. Well, if all this trade wars escalate, it's going to obviously affect Africa's ability to take advantage of AGOA. You've already seen that in part of South Africa. You've seen in some of the other countries that are exporting things to the United States. So I think it seems to me that the move is more towards bilateral trade relations as opposed to multilateral trade relations. And I think that's just going to complicate quite a lot of things. Already now, even the rules of origin problem will become a problem, because if you actually have Chinese companies that are probably, here in Kenya, that are producing particular goods with Kenyan, and you can say, well, if you slam tariffs on things that are coming from China, and they say, well, those companies are also Chinese companies, and all of a sudden, you get yourself caught up in that.
And moving on now, South Africa's Reserve Bank this week slashed its growth forecast for the country and warned of rate hikes should the tensions between the two most powerful economies intensify. Now, the bank's Monetary Policy Committee was unanimous in its decision to make no changes to lending rates as a result of increased risks to inflation as well as growing global trade uncertainty. Here's Sumitra Naidu once more with the details.
The Reserve Bank governor delivered a short, terse statement, painting a rather grim picture of what lies ahead as global tensions continue.
We do know that a rise in protectionism does lead to a rise in domestic prices. And so in many of the countries where they decided to embark on protectionist measures, there is bound to be reduced competition in those markets, which then means that the pricing power of producers in those markets increases, and as such, inflation is bound to rise in those markets.
Economists, too, are concerned about what the US-China trade war will do to the already weak South African economy.
We don't know how long this war is going to continue. Given our experiences in 1929, where all countries went on protectionism, that we may push the world at large, including South Africa, back to a deflationary environment, which doesn't spell very well for our economy. Therefore, the governor's issue is really about how is he going to manage monetary policy with so much uncertainties beyond even our policymakers.
South Africans that were hoping for some relief this week will now instead have to tighten their belts. The Reserve Bank governor warned that rates will have to go up 4, even 5 times in the next few years if this trade war between the US and China escalates. Domestic pressures are also creeping in, which could see inflation pushing closer to the upper end of the 3 to 6% target band sooner than anticipated.
The electricity tariffs, the higher ones, are going to kick in next year. Public sector wage settlements, well above the inflation rate, closer to 10%. And remember that the public sector sort of sets the benchmark for the private sector. So above inflation, wage settlements in this environment are just going to add to the inflationary pressure, and we could start seeing that demand pressure, starting to lift.
The Reserve Bank lowered its growth forecast from 1.7% to 1.2% for 2018. It follows the shocking 2.2% GDP contraction recorded in the first quarter of this year. At this stage, the only thing the Reserve Bank can do to help heavily indebted consumers is to keep rates on hold for as long as possible. Sumitra Naidu, CGTN, Johannesburg, South Africa.